guys, good day. This is John Francis Kulan and one of the member of Group 3, and we're going to report our assigned topics in which currency futures and options, financial swaps, and exchange rate forecasting.
Hi, good day. I am Richie Horolan Gagenti, and I'll be discussing about the currency futures and options. The Chicago Mercantile Exchange, or CME, is one of the largest and the oldest exchanges in the world. It is also known as the Merc and was founded in 1919 as a non-profit organization. So meaning a group organized for purposes other than generating profit, in which no part of the organization's income is distributed to trade spot and futures commodity contracts. In 1972, the CME introduced future trading in foreign currencies through the International Monetary Market, or the IMM. The IMM is the division of the Chicago Mercantile that deals with the trading currency and interest rate futures and options as an alternative to regular forward contracts offered by the commercial banks. Most major exchanges around the world have added currency futures in recent years. So in the future contracts or in the futures contracts, there the buyer and the seller agree on. The first is a future delivery date. A future delivery date, it is the final date by which the underlying commodity for a futures or forward contract must be delivered. Second one is the price to be paid on the future date, meaning the buyer is taking on the obligation to buy and receive the underlying when the futures contract expires, and the seller of the futures contract is obliged to provide and deliver the asset at the expiration date. The third is the quantity of the currency. So the quantity of the currency specifies the price of exchanging one currency for another at a future date. There are two distinct classes of traders in the currency futures market. The first is the hedgers. Hedgers buy and sell currency futures contracts to protect the home currency of foreign currency denominated assets and liabilities. It's only for the safety. Second is the speculators. On the other hand, speculators buy and sell currency futures contract for profit from exchange rate movements. The futures market and the forward market. These two are the agreement to buy or sell a commodity at a set price in the future, or these two as an agreement which have a different platforms. So when we're talking about the futures market, are normally available in a predetermined amount. So meaning a predetermined amount is a cost estimated for it is computed in advance, and for one of several specified maturity dates. So meaning the buyer and the seller of the contract are agreeing to a price today for some asset to be delivered in the future. Next is the forward market. Forward market offers contract for a specified amount of currencies tailored to particular needs. The futures market and the forward market differ in notable ways. First is the price range. They differ in the price range because the CME specifies a maximum daily price range. A futures market is not exposed to more than a limited amount of daily price range, but forward contracts have no daily limits on price fluctuation. The second is the differ in the maturity. Futures contracts are available for delivery on one of four maturity dates per year, but banks offer forward contracts on any date. Third is the size of contract. Futures contracts offer only standardized contracts in predetermined amount, whereas forward contract offers contracts for only specific amounts of currencies to specific needs. Fourth is regulation. futures market is regulated by the Commodity Futures Commission, but the forward market is self-regulating. Fifth is the settlement. Less than 2% by the CME or the Chicago Mercantile Exchange futures contracts are set by actual delivery, but more than 90% of forward contracts are settled. Six is the differ in the location. Takes place in organized exchanges, but forward trading negotiated directly between banks and clients. Next is the credit risk. The same A guarantees to deliver the currency on schedule if the seller defaults or to acquire if the buyer defaults. On the other hand, a bank dealing in the forward market must satisfy itself that the party with whom it has a contract is creditworthy. 8. Speculation. CMA brokers accommodate speculative transactions, whereas banks generally discourage speculations by individuals. 9 is collateral. A security deposit margin must back every futures contract, but forward contracts do not require any margin payment. 10. Commission. In the futures market, commissions of intermediaries depend on published brokerage fees and negotiated rates in block trades. In the forward market, a spread between the bank's buy and sell prices sets the commission of intermediaries. The last one is the differ in trading futures. Futures contracts are traded in a competitive arena, but forward contracts are traded by telephone or telex. And now let's move on to the next topic, which tackled about the market operations. An agreement to buy a futures contract is a long position, and an agreement to sell a futures contract is a short position. So margin requirements. Some form of deposits ensures that each party fulfills its commitment. This type of deposit is called margin. There are two basic types of margin required. The first is the initial margin, is the amount market participant must deposit into their margin account at the time they were into a futures contract. The second one is the maintenance margin, is a set minimum margin customers must always maintain in their account. The currency options market. Philadelphia Stock Exchange, founded in 1790, the oldest securities market in the United States, started currency options trading in 1983. Since then, the Chicago Mercantile Exchange and the Chicago Board Options have added currency options trading. Currency options are currently available in 6 currencies at the Philadelphia Exchange. The first is the Australian dollar, the British pound, the Canadian dollar, the euro, Japanese yen, and last is the Swiss franc. Basic terms. Currency options give the holder the right to buy or sell a foreign currency at a set price on or before a specified date. There are two types of options, and that are calls and puts. So a currency call option gives the buyer the right but not the obligation to buy a particular foreign currency at a specified price at any time during the life of the option. A currency put option gives the buyer the right but not the obligation to sell a particular foreign currency at a specified price at any time during the life of the option. Currency option premium is the price of either a call or a put that the option buyer must pay the option seller or the option writer. In general, an option premium is the sum of intrinsic and time value. So when we are talking about intrinsic value, is the difference between the current exchange rate of the underlying currency and the strike price and the price of the underlying money. So the time value is the second major component of an option premium, which is the amount of money that options buyers are willing to pay for an option in the anticipation that over time a change in the underlying spot rate will cause the option to increase value. The value of exchange rate volatility of the underlying spot rate is one of the most important factors that influences the value of the option premium. Volatility measures the fluctuation in price over a given period of time. So that's the end of my topic and to be continued by the second reporter. Thank you.
So this is my summary about chapter 6.5 until 6.6. So market value is the highest price that a willing buyer will pay for a good or service, and the lowest price at which a willing seller will sell it if both the buyer and seller have all the relevant information concerning the purchase, and the good or service information concerning has been exposed to the market for reasonable times. So my summary also in chapter 6.7 is currency futures, a futures contract for currencies that specify the price of exchanging
Good morning, I am Ainel Escaranay. So this is the continuation of the report of chapter 6, which is currency, future and options. So now we're going to move on chapter 7, which is financial swap. In finance, a swap is an agreement between two counterparties to exchange financial instrument or cash flow or payments for a certain time. So financial swap is exchange. When we're going to talk about financial instrument, is bonds, stocks, or cash flow. So if we're going to talk about financial swap, it is a swap, or the instrument can be most anything, but most swaps involve cash base on a national principal amount. So if swap, we're going to swap that certain product or that certain amount of stocks or bond into cash maybe, or bonds to bonds. It depends on the agreement of the owner. So next is the emergence of the swap market. Since the swaps are highly customized and not easily standardized, the swap market is considered over-the-counter market, meaning that the swap contracts cannot be typically and be easily traded on exchange. So in swap, they are stated here that it's not as you're going to swap it a rush or something like it is very easy. It is not. It is something like go into process, but it doesn't necessarily mean that swap are not illiquid instruments. So in regard to talk about illiquid, that is because liquid is cash, something like run in your business. For example, the most liquid asset is cash. So if we're going to talk about illiquid, that is or not liquid, it is property or plant and equipment. So this is not literally an illiquid, but it is liquid, but it cannot be swapped easily. The swap market is one of the largest and most liquid global marketplaces, with many willing participants eager to make other side of a contract. So it is very important. It is one of the most really seeking to all investors and the investor who really wanted to swap in the global market. It is because you're going to maybe you can be able to have an advantage of swapping, and it really affects of how you are going to be to expand or something like having a comparative advantage with your business. Next is plain vanilla swaps. Plain vanilla swap interest rates. The swap are the most common swap instrument. They're widely used by government, corporation, institutional investor, hedge funds, and numerous and other financial entities. So plain vanilla or vanilla swap, it is the swap that is widely used by governments, corporations, institutional investors, hedge funds, and numerous financial entities. And also, a plain vanilla swap is also called generic swap. It is the most basic type of financial derivative products helping institution on a firm's managed risk. So it is something like swap that you are going to help of certain business in order them to uplift in the risk that they have into their business. So it is very important, and it's really helpful to the business into the or it is very important and very helpful to the business in order to make them have a better profitable business in their journey. Motivation for swaps. The motivation for swap or motivation of using swapped contracts is fall into two basic categories: commercial needs and comparative advantage. When we're going to talk about commercial need, it is something like you're going to expand your product, maybe domestic or international. So if we're going to it may be one of the purpose of the swap. It is because of you are going to have a expansion or to have a expansion and towards other country or internationally. In comparative advantage, you're going to swap. It is because you are seeking the advantages towards your competitors, and it is very more important also. It is because this is one of the key factor that you're going to develop and to become a one highly profitable business institution. That's all. Thank you.
So hello everyone, by the way, I am Rika Katakutan and I will be going to talk about measuring exchange rate changes and the forecasting needs of multinational company and also the other uses of it. Exchange rate forecasting. Measuring exchange rate changes. An exchange rate is the price of one currency expressed in terms of another currency. As economic conditions change, exchange rate may become substantially volatile. So what drives exchange rate? So exchange rates are constantly moving based on supply and demand. Whether one currency is in higher demand than other, it depends on the perceived value of owning it, either to pay for goods and services or as an investment. A decrease in a currency's value relative to another currency is known as depreciation or devaluation. So when we say depreciation, it is defined as the reduction of the recorded cost of a fixed asset in a systematic manner until the value of the asset becomes zero or negligible. The forecasting needs of the multinational company. First is the hedging decision. Multinational companies have a variety of foreign currency denominated payables and receivables. It means strategically using financial instruments or market strategies to offset the risk of any adverse price movement. Second is the working capital management. It consists of short-term financing and short-term investment decision. When we say working capital management, it is a business strategy designed to ensure that a company operates efficiently by monitoring its current assets and liabilities to their most effective use. The third is the long-term investment analysis. The evaluation of foreign direct and portfolio investment requires exchange rate forecast well into the future. Investors use quantitative analysis to evaluate the financial stability of a company, while some investors prefer to use single analysis method to evaluate long-term investment. Fourth is the long-term financing decision. With multinational company issue bonds to obtain long-term funds, they can denominate their bonds in foreign currencies. Long-term financing decisions are decisions that are taken for a period of more than a year or more. These may include capital budgeting and investment decisions. The other uses of forecasting needs of the multinational company. There are additional situations that require companies to use exchange rate forecasting. First, companies need exchange rate forecasts to assess foreign subsidiary earnings. Second, if a company wishes to buy or sell a product in a foreign currency, it has to forecast the effective exchange rate at the time of transaction. Third, if a company wants to remit its foreign profits to the parent country at some point in the future, it has to forecast the effective exchange rate at the time of remittance.
Forecasting floating exchange rate. Exchange rate forecasting means to estimate the rate which will be any of future date. It is just expectation of currency rate. In future, our currency may be depreciated or may be appreciated. So in forecasting floating exchange rate, there are three common ways to forecast currency exchange rate. So first, this is the purchasing power parity, and second is the relative economic strength, and the last is the economic models of forecasting exchange rate. So, purchasing power parity. The purchasing power parity is perhaps the most popular method due to its indoctrination in most economic textbooks. The PPP forecasting approach is based on the theoretical law of one price, which states the identical goods in different countries should have identical prices. So relative economic strength, it means that relative economic strength, as the name may suggest, the relative economic strength approach looks at the strength of economic growth in different countries in order to forecast the direction of exchange rate. So, economic models of forecasting exchange rate is economic models of forecasting exchange rates. Another common method used to forecast exchange rates involves gathering factors that might affect currency movements and creating a model that relates these variables to the exchange rate. So now, is fixed exchange rate is good? A fixed exchange rate helps to ensure the smooth flow of money from one country to another. It helps smaller and less developed countries to attract foreign investment. It also helps the smaller countries to avoid devaluation. Many countries that operate of their currency and keep inflation stable.